India Inc.'s boards and managements would do well to align their agendas with the broader interest of all their shareholders. In particular, institutional investors, backed by recommendations from proxy advisory firms, have brought corporate governance issues to the center stage. Recently, PNB Housing Finance dropped its plans for a preferential issue of equity shares to raise Rs 4,000 crore from a group of investors led by Carlyle. The plan ran into controversy after a proxy advisory firm raised objections. Subsequently, the deal was halted by SEBI. Consider also the case involving Reliance. In July, Yasir Al Rumayyan, the chairman of Aramco and the governor of Saudi Arabia's sovereign wealth fund, was appointed as an independent director on the Reliance Industries board. The appointment recently came up for shareholder vote, and the voting process was slated to end on October 19. Based on proxy advisory firm Glass Lewis's recommendations, the California State Teachers Retirement System had said that it would vote against Al Rumayyan's appointment. Companies such as Jindal Steel and Power, Phenolux Cables, and Z Entertainment Enterprises Limited, among others, have also come under the lens of proxy advisory firms in recent times. Clearly, India's corporate governance landscape has changed in recent years, especially with proxy advisory firms weighing in on more and more instances. But what explains this change, and how can companies cope with what lies ahead?
How companies should react to it, they have to kind of wake up to the fact that there's a new reality which is there. I go back about 5, 7, 8 years and we look at how were institutional shareholders voting. There was about 10% vote, 90% was abstain. If we look at more recent data, it would be about 85-90% of the shares are getting voted about. The remainder 10 to 15% is abstain. So therefore, investors are having a point of view and they're expressing this point of view through their vote rather than meet up with companies, meet up with managements and say that, look, these are some of the areas where it's an area of concern. Even there, I'd like to say that investors used to tiptoe around issues rather than be a little bit vocal about it. Investors are much more vocal. The second thing which we have when we talk to investors is that often what is the issue which they're confronting? They're finding that there's not enough clarity which is being provided on the resolutions. And therefore, they're saying that, look, if the company intends to do something, they might as well be clear about what is it that they want to do. An example being sometimes they have a resolution for fundraising. It could be a little bit of debt, it could be equity, it could be QIP, it could be GDR, ADR, whatever it be. Now, I understand that companies want to be a little bit opportunistic, but it may be appropriate for the company to say that, look, we have a target debt equity ratio. And if we kind of steer away from this ratio for a brief while, we're going to come back and bring it back to what we believe is the appropriate ratio for our business. Now, in the absence of that, and you just say, look, I want to raise money, it could lead to a dilution of about 20-25%, and investors could get quite agitated about it and vote against the resolution. We looked at data for last year. Institutional shareholders supported 97% of the resolutions or voted for in 97% of the cases when resolutions were presented. So they're also a minuscule amount, and those are the ones where they need to focus on. Which are these resolutions? These tend to be, you can't say there's any one. They tend to be across, whether it is director appointment, compensation, ESOP resolutions, related party transactions, what have you. But they all come about because there isn't sufficient clarity which the companies are providing.
Let's be clear. The majority of resolutions still get the nod from shareholders without any contest. But even the minuscule number of resolutions that make the news for the wrong reasons point to the coming of significant changes in the years ahead.
There are various factors which are changing the which are changing the corporate governance landscape in the country. And I think it is just the beginning. Maybe 2-3 years down the line, you will feel or you will not be able to see that, oh, that was the governance position in 2010 and what we have come. So I think I'm very hopeful in another 2-3 years, the overall governance of the listed company would see a sea change.
companies also need to appreciate how and why things have changed in the past decade.
I would say that in last a decade or maybe 9 years, things have changed a lot in India, and a lot of credit goes to regulations which have been framed by Ministry of Corporate Affairs in the form of Companies Act 2013, SEBI regulation in the form of LODR, and also very important by all the regulators, SEBI, PFRDA and IRDA, in making stewardship code and making voting mandatory. Not only that, SEBI has gone one step further and said abstain is not an option anymore and you got to vote. This together with the revolutionary change that is e-voting has made a lot of difference, because participation of institutional investors in the voting has improved considerably for these reasons.
The message being thrown up by the increasing instances of shareholder activism is clear. In a public company, promoters and management need to take the investors along with them. Most importantly, the first step India Inc. should take is to provide more clarity to investors going ahead.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.